Right now, many stock markets in the world are falling, but Bitcoin is holding strong. And that confuses a lot of people because normally, when there is a war, uncertainty, and fear in the world, people expect every market to crash. But markets don't work based on emotions, markets work based on money flow. And today, I want to explain this in very simple English. No complicated trading words, just logic that anyone can easily understand. Because if you understand how money moves in the market, you will stop reacting emotionally to all the news you listen to. Let's start with what actually has happened. When the war headlines first appeared, the market reacted instantly. Bitcoin dropped from around $65,000 to about $63,000. People panicked. Traders started selling. Social media was full of messages saying markets are crashing. But then something interesting happened. Bitcoin did not collapse. Instead, recovered. It started moving back towards $70,000. At the same time, many stock markets across the world were still falling. So, the real question is not why did Bitcoin drop? The real question is why did it recover so quickly? To understand that, we need to understand how markets actually move. Most people believe markets move because of news, but news is only a trigger. The real driver behind market movement is where money is sitting in the market. Let me explain this with a simple real life example. Imagine a large shopping mall during a sale. People rush into the store. Everyone wants to buy the same popular product, but the store owner wants to sell many different products. So they move customers around the store. First, they attract people to one section, then they move them to another section. Markets work in a similar way. Big institutions trade billions of dollars. They cannot simply press buy or sell and get their order filled instantly. They need a lot of people on the other side of the trade. That's where the concept of liquidity comes in. Now, liquidity sounds like a complicated word, but it's actually very simple. Liquidity means available money in the market to trade with. If someone wants to buy a large amount of Bitcoin, someone else must sell it. If someone wants to sell a large amount, someone else must buy it. Large traders need areas where many orders exist, and those areas usually appear when traders panic. Let's go back to the Bitcoin drop. When the war news appeared, many traders became scared. They started selling. Many traders also had stop losses below the market. A stop loss is basically a safety exit. If price reaches that level, the trade will close automatically. Now, let's imagine thousands of traders placing their stop losses around similar prices. When the market drops, those stop losses get triggered. That means a large number of orders suddenly enter the market. That cluster of orders becomes liquidity. And when liquidity appears, large players can enter the market more easily. So when Bitcoin dropped quickly from $65,000 to $63,000, the drop may not have been weakness. It could simply have been the market collecting liquidity. Once those stop losses were triggered and panic selling slowed down, buyers stepped in. That is when the price started recovering. This is why the first move in markets is often emotional, and the second move is often more intelligent. Now, let's compare this with stock markets. Stock markets trade only during certain hours. They open, they close, but Crypto markets never stop. Bitcoin trades 24 hours a day, 7 days a week. So when global news hits the market, crypto often reacts first. Sometimes it drops first, sometimes it stabilizes first. Right now, crypto is reacting faster than traditional markets. Another important factor is capital movement. When global uncertainty increases, investors start moving money. Some move money into the US dollar, some move money into gold, and in recent years, some people move money into Bitcoin because Bitcoin is global. It is not controlled by any single government and it can move across borders instantly. This makes Bitcoin attractive to certain types of investors during uncertain times. But this does not mean Bitcoin will only go up. Markets never move in a straight line. There will always be corrections. There will always be volatility. The key is to understand what happens after the first reaction. Does the market continue falling or does it stabilize and recover? That behavior tells us more than the news itself. Now, let me talk about something important. Many traders lose money because they chase the first move. They see the market dropping fast and they sell, or they see market rising fast and they buy. But that first move is emotional. Professional traders do something different. They wait, they observe, they ask simple questions. Is panic increasing or is panic slowing down? Is selling getting stronger? Once the reaction slows, the real opportunity begins. And this is exactly what we teach inside our program. Inside the course, we focus on understanding how markets really move, not based on guessing, not based on random indicators, but based on structure, liquidity, and discipline. We teach traders how to read the market step by step, how to control risk, how to avoid emotional trading. Because trading is not about predicting the future. Trading is about reacting intelligently to what price is doing right now. Once you understand that mindset, everything else will change. You stop chasing candles, you stop over trading, you stop reacting to every news headline. Instead, you become patient, and patience is one of the biggest advantages a trader can have. Now, coming back to the current market situation, Bitcoin has already reacted to the news. It dropped, it collected liquidity, and then it started stabilizing. This tells us that buyers are still present in the market. But remember something important. Market always moves in cycles. There will be new pullbacks. There will be new volatility, and that is normal. Your job is not to predict every move. Your job is to protect capital and trade with discipline. Let the market show its intention. Let the emotional reaction happen first. Then step in when the picture becomes clearer. That approach alone can save traders from many unnecessary losses. Before we end it, I want to remind you of one simple rule. Your job is not to be part of the panic. Your job is to observe it and position yourself after it. If you want to continue learning and discussing markets with serious traders, you can join our free Discord community. That's where we share ideas, discuss market movements, and help traders stay disciplined. No hype, no shortcuts, just learning, structure, and a community of traders improving together. Stay patient, stay disciplined, and let the market come to you.